Earlier, we provided you with a format for the income statement where we looked at revenues minus expenses. This version, called the single-step income statement, was simple to produce. However, it doesn't always provide enough information for a reader to truly understand how a business operates. Adding to the complexity of the income statement by including merchandise operations, we need to provide a more detailed format for the income statement. The single-step income statement was relatively simple in that all we had to do was subtract our expenses from our revenues. It was simple to provide and it was simple to read. As you may have remembered, that this was the format for a single-step income statement, taking your revenues, subtracting your expenses, and then obtaining your net income. A more detailed look at the income statement is called the multi-step income statement. The advantage of the multi-step income statement is that it highlights the components of the income statement. We look at sales, cost of goods sold, the gross profit, the income from operations, and the net income. So, a multi-step income statement may look like this. Notice here for the 2 years 2009 and 2010, we show the sales minus the cost of goods sold that we computed in the prior video. Subtract the cost of goods sold to give us gross profit, which is the profit made on the sale of the inventory. Then we subtract out the operating expenses to get the income from operations. Income from operations is the income generated from the company's daily operations. Then we take into account the revenues and expenses that were generated by the company that is not part of normal operating process. That would then provide us with the income before taxes. Then we compute the taxes to provide us what the true net income value is. So let's take a look first at net sales. Whenever you hear the word net, we are talking about a value that has been reduced because of the contra accounts. So when we say net sales, we are looking at total sales less the two contra accounts, sales returns and allowances, and sales discounts. We then subtract out cost of goods sold to give us gross profit. Gross profit tells us this is the amount that we've made on the sales of our inventory after the returns and allowances and discounts. We take into account our operating expenses, which are our normal expenses that we incur from our daily operations. Subtracting that out, it provides us with the income from operations. Then we take into account our non-operating activities, which are the activities that were performed that isn't part of our day-to-day operations. Some examples of non-operating activities include interest revenue, dividend revenue, rent revenue, and gains from the sale of property, plant, and equipment, or interest expense, casualty losses, which are losses that are incurred from destruction or vandalism to our property, as well as any other losses that aren't part of our daily operations. Which then, after we take into account our income tax, we come up with net income. Now compare this financial statement to a single-step income statement and we will come up with the same net income value. The difference is the multi-step income statement tells us a lot more information as to what the company has been doing and how well it's doing as a whole. Now, If you're not doing the perpetual inventory system, you need to be able to compute cost of goods sold using the periodic system. In the periodic system, we do not make the journal entry to record cost of goods sold until the end of the period. So we showed you that formula in an earlier video where we said take your beginning inventory plus your net purchases, which are the purchases minus the returns and allowances minus the discounts, to give us goods available for sale. Then we go out at the end of the period and count what inventory is remaining and value that inventory. Subtract that value from your goods available to give us cost of goods sold. We do that at the end of the period because that's the best time to consistently apply that formula. So here's an example of what that cost of goods sold formula computation would look like. Take the beginning inventory of $36,000, the gross purchases of $325,000 minus the contra purchases of the returns and allowances and the discounts gives us our net purchases. We want to add in our freight because remember, the whole idea of valuing inventory is what it costs us to get it into a saleable condition. We then determine how much is available for sale. We subtract out the ending inventory to give us our cost of goods sold. This formula is very consistent with almost every other account besides cost of goods sold. So think about it as take your beginning balance with what increases the account, subtract out what decreases the account to give you what your ending balance is.